There are a handful of banks that are so large and important to our economic system that it is implicitly understood that the government would bail them out in times of trouble rather than let them fail. We say that these banks are too big to fail. At the end of 2012, there were 12 banks, just 0.2% of all banks, that held 69% of industry assets. If they did fail, we think that it would wreak havoc in our banking system and our financial markets. Of course, this implied safety net causes a slew of problems. Banks may take excess risk because they can't fail. Shareholders and creditors don't do their due diligence before investing or loaning money to the banks. Depositors loan money at lower rates, creating an unfair subsidy for these large banks and hurting smaller banks. Regulators have little impact on these banks because the banks can't be shut down. When we bail out the banks, these banks live on as sick banks, so they don't lend, and that means the Fed's accommodative monetary policy isn't effective. There have been several solutions recommended for the too big to fail problem. Some examples include only providing FDIC insurance to pure banks, not allowing them to have trading operations or engage in shadow banking, or requiring banks to issue contingent convertible debt, bonds that would turn into equity if a bank ended up in financial distress, or even putting pure limits on the size of banks. In sum, too big to fail is effectively free insurance that taxpayers provide to the biggest banks. Banks don't want to give up this insurance, but the real problem isn't just that these banks are too big to fail. They may be too big for us to save.